What's going on, folks? Ron here with Insurance for Texans. I have got one Ashley Hodge here with me today. And Ashley is an extraordinary financial advisor. He's been at this a long time, seen a lot of stuff, experienced 2008, and is still kicking, doing what he's done all along. And I thought that it would be helpful for Ashley to get some information with respect to the CARES Act and all of the financial things that are going back and forth. There's a lot of misinformation out there. So I thought Ashley could help us get some good information about how this whole situation can impact your personal finances, and insurance can play in there in some aspects, depending upon how you look at it. So Ashley, tell us a little bit about your background and how you work with clients.
Sure. I've been in the investment management business for almost 30 years, not quite 30 years, I think 27 years now. And so I started in 1993. I worked with Merrill Lynch in Fort Worth. I worked with UBS, and I've been on my own since 2004. And I am a wealth manager. I manage money for clients, helping them plan for retirement, for financial freedom, college education, estate planning, all the things that come with wealth management. So I've been through a few of these crises. You know, we went through the 9/11 situation, obviously 2008. This is unique. It's different in a lot of ways, but it's definitely been one for the ages.
So is there, from a consumer standpoint, from a homeowner standpoint, because we deal with a lot of homeowners, because that's one of the things we specialize in, a lot of small business owners. Is there a prevailing thought that you're seeing amongst the research and everything that's coming down the pipe with respect to how the market's going to respond over the next 6 to 12 months? I know that's a loaded question.
Yeah, I don't know if I would say a prevailing thought, but I would say in general, a lot of the conference calls that I'm listening to, the theme has been that we probably will see an initial V-shaped recovery. I think the general thesis is that we may be in lockdown, not through the end of April, but through the end of May.
Oh, wow. Okay.
Yeah. So I think that's what the market is currently priced in. So that's the good news.
Okay.
So I think that, a June 1st restart is really where the projections are, and that we would initially see this almost like V-shaped recovery, but it's not going to just continue along that path. I mean, it's going to, it may take 2 years to recover to get the economy, where it was at the beginning of 2020. Now, your investments may perform a lot better than that, because we've already seen $2 trillion worth of stimulus that's been poured into the economy.
Okay.
And then I think, the prevailing wisdom is we may see up to another $3 trillion. So almost $5 trillion worth of stimulus is coming total. And so if that happens, I would think that it's going to favor, this risk on assets, after we get back to a normal pace of life. And I would project that to be June.
So so let's talk about the stimulus money a little bit. There's lots of aspects that are coming through, both from a homeowner standpoint and a business owner standpoint. I know myself, the $10,000 SBA, that's something I'm taking advantage of. Have you got any insight on what that looks like for a small business owner?
I'm still digesting that, so that's probably not in my wheelhouse to speak intelligently on. I'll just say this. I would say that if you're a small business owner with less than 500 employees, then there's absolutely some programs that can be to your benefit. The one that I've been reading on today is the Paycheck Protection Program. Are you familiar with that?
That's
it's a PPP. And basically you'll get 2 months worth of payroll protection, or you'll be able to pay your employees 2 months worth of income, as long as you don't lay them off, as long as you can show that you're still employing them through this process, that you're going to get a forgivable loan from the government, which is administered by the Small Business Administration lending
And
program.
that's exactly that's the one that seems to be garnering the most interest right now,
Right.
because it is forgivable. It's not
Yep.
something that just has to be paid back, as long as you're keeping those folks on,
Right.
and not creating more unemployment after the numbers that came out.
Correct.
What are you seeing? So on the personal side, what are you seeing from? Everybody talks about the checks.
Right.
Do you have any insight there as to what that's looking like for your average person that's living in Hershey's, Bedford?
No, again, it's the devil's in the details, right? I mean, I know the $1,200 figure has been floated, that most people are going to get a $1,200 check if they make below a certain income threshold.
I believe it's 75,000 for an individual, and then it
Correct.
could be double that, the 2,400 if you're below 150, I believe.
Right. And and to be candid, I think this is for my business. I don't know about your business, but it's been pretty chaotic. I mean, it's created a lot more activity. So it's almost like drinking from a fire hose. I mean, the weekends are the times that I have to really digest the legislation, and so from an activity standpoint during the day, it's mostly been on the phone talking with clients.
Okay.
And what's interesting about this is it's this weird deal where there's worries about your health,
Sure.
certainly if you're at high risk, for if you got the coronavirus and you've got some existing medical conditions, there's a lot of stress of, I can't get this. I mean, this could, be my death sentence if I get it. So there's those stresses. Then of course there's a stress of seeing this radical drop in the stock market, which
Sure.
hopefully will be short-lived, and we'll see recovery by the end of the year. But that's stressful if you're looking at your balance and thinking that this could be, the new normal or something that's going to last forever. And then I think you have this interesting dynamic where people are at home watching the news a lot, and so they're not out and about in the marketplace as much. And so, I think it's been kind of a toxic combination of worry from that standpoint. So unfortunately, I've had to spend a lot of time on the phone trying to dispel myths and try to talk through some of the things that they're hearing, and I've heard some doozies, but so my answer is I don't really I haven't really dove into the CARES Act and all the details yet. I've done a glance. I've seen the summaries of it, but I plan on doing it this weekend. Yeah.
So you mentioned myths. What are there some prevailing myths that you're hearing from your client base?
Oh, I've heard a bunch. Like one of the funnier ones was that this is going to cause rolling blackouts, and the rationale is they said, well, everybody's at home using all this power, that's going to just overload the grid. But if you think about the common sense of that, well, if you don't have schools using power, if you don't have restaurants and businesses using power, then naturally consumption may be at the same level or even less. I don't know the numbers, but it's
more so
it's
than when it's 157 degrees outside in the middle of July. I mean, my AC's not running right now, so
you do hear some crazy thoughts. But there's, I think the big thing is that assuming that this spring is, that the fall is going to be even worse than the spring, that next spring is going to be even worse than this spring. And that's just probably not true. And the reason you would say that is because obviously the more data that they gather on this disease and the more they're able to prepare for the next wave, the better shape the healthcare system will be in this country and in other countries as well. So I think we'll be dealing with this for a while, but it won't be the fall and the spring of next year should not be a repeat of this situation.
The lack of data has been probably the most disconcerting part of the whole thing, because the unknown, you talk about that, the worry and the fear from all of those different places, the complete unknown that goes with the lack of data with this new virus has
Right.
created that sense of we don't know.
Right.
So is there for the guy who's mid-career that still has 15 years left? I mean, obviously, there's certain things that you want to plan for. You want to make sure you have good life insurance. You want to make sure you have good health insurance. Um, are there sage words of wisdom that you can tell that guy that's, he's got a home, he's got a couple of cars, he's got a couple of kids, he's still employed working from home, and oh my gosh, he's trying to homeschool at the same time, and it's
Right.
crazy. Are there sage words of advice from a forward thinking perspective about how to continue to plan for what comes later?
Yeah, this creates some great opportunities. I think, one thing to look at is there may be a potential to convert IRAs to Roth IRAs.
Okay.
When valuations are depressed, then, the idea of taking that depressed valuation in an IRA and converting it to a Roth, and the reason you would do that is because the Roth grows tax-free.
Okay.
So, we're making an assumption that the growth rates are going to be better today than they were 3 months ago. I think that's a safe assumption.
That's fair.
Because
Yeah.
the market's fallen, and the more prices fall, the better the expected returns would be on the other end of that, assuming we have normal business cycles going forward. So, if you were able to convert an IRA, pay the taxes now, and then get it into tax-free situation going forward, that's something interesting to look at from a planning perspective. And I just think, it's important to have a good plan in place and to not deviate from that plan during times of crisis. It's always counterintuitive, but when prices fall, that's good. It's a good time to be buying. It's a good time to be reallocating your asset allocation, taking money out of conservative investments and putting them into riskier investments.
Okay.
It sounds like, something crazy to do. It's fearful to do that now. But, this is when you want to invest in risky assets, when the expected returns are in your favor. You want to, take risk in times of crisis, because that's when you get the good prices. So I think that's something to be looking at. And the analogy that I always give is, and why I think it's important, I call it an investment policy statement, where, you have a simple plan of how you want to manage your money, and you follow that investment policy statement as much as you can without emotion. And, the analogy I give is it's like a pilot. When a pilot's trained to fly a helicopter or a plane, they're really, it's implanted in their mind to trust their instrument panel, because there's going to be times when they're in the air where it feels like they're going one direction that they're not going. It feels like they're diving when they're flying. I'm not a pilot, so I can't use the terminology that they would use. But the point is that you get spatially disoriented as a pilot, or you can. And
Sure.
a lot of pilots have died from going by gut instinct versus trusting your instrument panel. So I think that an investment policy statement or an investment plan is your instrument panel, and it's a good time to really revisit. How much risk am I comfortable taking? How much do I need to have in conservative investments, making 1%? That's about the best you can do right now. And then how much do I want to have at risk to make greater returns, and really stick to that plan. And
Okay.
The worst thing you can do is to panic out at a bottom and then to buy back in after the prices have gone up 30%. That really hurts your long-term return. So I guess that's my general advice.
So there's a couple of things that I heard you say, and you talked about the conversion to the Roth and doing that while things are down. So paying the taxes, obviously, if you're paying taxes on a lower amount, you're reducing the tax amount. And if it's growing tax-free, that's in your advantage. But it's also making an assumption that taxation levels in the future are not going to be lower than they are today. And you when we first started talking, you mentioned $5 trillion in stimulus.
Yeah.
Eventually, we got to pay that back, right? So there's the idea that taxes would continue to shrink. It's kind of not thinking in the right fashion if we're ever going to pay that back.
Right. I mean, you know, the good news is, as long as there's this insatiable appetite, which there is right now for government debt, and even government debt below 1%, you know,
True.
the government can borrow money at historically cheap interest rates. And so that's to their advantage to do
Sure.
that. But eventually you would think there's a point where those rates go up, either because investors don't believe in the power of the U.S. government to pay it back, or just inflationary pressures drive interest rates up.
Sure.
So yeah, I think, but you're right. I mean, I would say the idea that, you know, we would see lower taxes going forward with all this government debt on the plate doesn't seem to make a lot of intuitive sense. I mean, a lot of things that don't make intuitive sense come true the last 5 years, but
Sure.
yeah, I think you're on
Sure.
right.
Okay. Yeah. So the other piece that was in there, you talked about allocations, and this was something I heard on the radio the other day. When you get a major pullback in one of the marketplaces, the equities being in this case, what you used to have level per your risk tolerance can become wildly imbalanced because you've lost value in one piece. And that lends itself to a natural reallocation to make sure you're keeping your risk tolerance where you want it.
Right.
So that's something that I don't know that I'd thought about that before I heard them say that out loud the other day. So that it made a lot of sense to me.
Yeah, it's, you know, if you just put it in really simple terms, I know most people don't have, especially with interest rates as low as they've been, but if you had 50% in bonds or fixed income and 50% in stocks, and because of this drop in the market, you know, now your allocation is 60% bonds and 40% stocks, then it would make sense to take 10% out of bonds and reallocate it into stocks. And you'll usually be happy just following that simple strategy over time, because it forces you to sell high and buy low. And that's the nature of the game. You know, that's how you make money, is you want to be investing in times of falling prices, and you want to be selling. You know, I've had this conversation a few times. It's not the time to panic. The time to panic is when prices are good. You know, that's a great time to panic, is at the top of markets, if you can ever predict when those would be.
That's when everybody begins to push in, that's generally when I get nervous. So that's just me being an insurance agent. So
Sure.
but that is very helpful. That is great advice. Ashley, I appreciate the time today. And the insight into what you're seeing with your clients and what you're telling them to think about, and the ways to look at this as an opportunity rather than worry and fear. Because ultimately,
thank you, Ron, and thank you for taking such good care of me on the insurance thing too.
Well, you know, we try to do what we can, and we've helped a lot of homeowners here recently. We know that credit scores may start taking a little bit of a hit over the next few months as people lose income. They might skip some bills here, there, you know, whatever that looks like. And one of the things we're telling them, shop the insurance now while your credit score is still good. We can lock in the lower rates. Yep. So we're going to accomplish two things. We're going to save you the money now, and then we're also going to make sure that there's money to be saved, because that credit score is such a large driver of insurance cost in the state of Texas.
You know, that's a great point, and something we've seen in 2008. I don't know if this crisis will play out the same way, but you'll see that at the other, as there is a recovery, you know, the financial institutions may still be reeling from losses, you know, from the downturn, and so they may get tighter on their risk controls. So we saw that in 2008. You know, they were being encouraged to lend money, but getting them to actually lend the money was a whole nother matter. So I think it's really wise advice to be making
Yeah.
moves versus waiting a couple months.
And one of the things, and insurance agents don't like to talk about it because people go, what does my credit score have to do with
Right.
my insurance? And the actuaries, the guys that set the rates, they've got mounds and mounds of data that shows the correlation that you're much more likely to make claims if your credit score is lower, and they have lots of explanations for it. So we don't like to talk about it because it's a bit of an uncomfortable subject, but the fact of the matter is, if you've got a 770 today and you're afraid that 3 to 6 months from now you may have a 640, change your insurance now while you can take advantage of better pricing based off of the better credit score.
Right.
And
right.
that's all it is. It's got no other mechanism than that, because I can't tell you I'm smart enough to explain it.
Right.
I just know how the instruments work, so we take advantage of them. So yeah, no, I appreciate the insight, appreciate the wisdom, and the plug for taking care of your home insurance. And we'll see if we can't find another topic to talk about later.
Sounds good. Thanks, Ron.
All right, thanks, Ashley. Ashley with Hodges Capital. Did I say that right?
No, well, it's just Ashley Hodge, certified financial planner.
Okay.
Hodges Capital, I know those guys. That's a separate business.
Little bit bigger, but I didn't know if you called it the same thing. So,
yeah.
But certified financial planner, which is a big deal, and maybe we'll have another conversation about why that's so important.
Sounds good.